Chief Global Investment Strategist. Jeff, good to have you on the show this morning. Your team is working on the outlook for 2021. So I want to kind of get your take here on first what Kevin and I were talking about, the old kind of end of year Santa Claus rally. I mean, did we just get it out of the way in the record-breaking November?
You know, I think that we've got to brace ourselves for a little bit of a double dip. There could be some disappointing data that rolls in the month of December. We've got this risk of an economic double dip from the lockdowns we've seen in Europe, some of the restrictions we've seen put in place in states in the U.S., like in Michigan, a few other places, and some rolling lockdowns we've seen in Asia. All that coming together right now in this bridge period between between now and when we get the vaccine, and that means the market's going to need to look past what could be some pretty ugly data points. And you know, we got the ADP numbers this morning, a little bit disappointing. The jobs report on Friday could be a little disappointing. We're going to hear more from Chairman Powell today on some of the risks facing the economy. So that we've got to trust that the market's going to look beyond that to the Santa Claus rally, maybe bringing us a 2021 that looks a lot brighter than the end here of 2020.
Jeff, is another way to look at that this market is expecting a lot or pricing in a lot at these levels? It seems like right now we're willing to forgive some of the employment gaps that still exist. Jobless claims haven't been too hot the last couple of weeks. Seems pretty clear that situation has plateaued, at least for the moment. Maybe it'll change tomorrow, but just what we know so far the last couple of weeks, it's been a little rocky. Is it reasonable for the market to kind of have a put underneath it if we know vaccines are there? It seems like right now that is at least kind of buffering us to the downside.
I think it does, Oliver, but maybe for 80% of the market and not the 20 that has rallied so hard this year. You know, we've seen a real breakdown. If you look at the MSCI World Index, just to throw the whole world under the microscope, 20% of those stocks are up 25% this year. The other 80 are still down. Most of the market is not really recovered fully. And so I think where we've seen a lot of optimism is not in the cyclicals. We've only started to see those move in the month of November. I think a more complete recovery in 2021 will bring those stocks around. Now, I think, yes, a vaccine-led recovery, that's becoming the consensus, one of the reasons why stocks in general are moving higher. But I think what may not be the consensus is that the leadership may be coming from a lot of those laggard stocks. There may still be some opportunities out there because we might see leadership come from outside the U.S. for the first time in years. And we can see this in the current IMF estimates for GDP. The U.S. is expected to rise 3% next year and for its economy, but it's 5.2 for Europe and Canada, 5.9 for the UK, and that is translating into better earnings expectations. 20% growth expected next year for S&P 500 companies based on Wall Street consensus estimates, but that's 30 for Canada, 35 for Europe, and 40 for the UK according to consensus estimates. So I think the 2021 backdrop may see the U.S. pass the baton of global leadership to Europe. I don't think that's something we're seeing yet priced in the markets.
There's a chart you've got from your report. If we look at the earnings expectations, I mean, we're basically at the bottom of the list for much of the developed world here, which is a pretty interesting notion given that the strength of the equity market has been very domestic focused and U.S.-led. So in terms of whether or not that's enough to push investors there, this is the expectations for earnings growth. Right now, the U.S. market has enjoyed a lot of the valuation growth. So how do we kind of unlock that willingness by investors to pay up for those earnings outside the U.S.?
I think they have to actually see the growth. I think they have to actually start to see that come to fruition. And one of the ways is getting out of these lockdowns in Europe. So fortunately, we're just starting to see them end right now. We've got, let's see, Ireland, Belgium, and Poland just ended their lockdowns 2.0. They're reopening non-essential retailers. We're seeing later this week, France, a number of other countries moving towards loosening their restrictions, hopefully, and they've been successful in containing the outbreak. Hopefully they'll remain successful, and that's really important to limiting the economic damage from the second round of lockdowns. We know already this morning the UK has approved the use of the Pfizer and BioNTech's vaccine. That'll begin to be distributed. So hopefully the bridge to seeing that growth come back is not too far from where we are today. I think as we begin to see that unfold investors will begin to recognize that. Just a last comment on that, we've started to see some investor flows move in that direction. Since the election, we've noted the market has seen money come in from individual investors, but interestingly, a little bit more into international funds rather than U.S. funds, although both have seen net inflows.
Jeff, one of the things that's really interesting right now is when you look at the moves that we just had for November on a lot of different standards, they're fairly unprecedented, where they do match previous instances in history or right around big events. 1987, the Great Depression coming out of it. So if you look at it from that perspective, one could kind of make this case that there is a setup for a longer term recovery similar to these other periods of distress in the economy. But there's two glitches to that I see. One is that we're coming out of this recession in such a fast way. The V-shaped recession is actually allowed us to bid up our market here in the U.S. to even higher than it was. So we're at the records already. And then two, this U.S.-led recovery has created such a disparity that you're describing with the rest of the world. And the question is if the flows, as we see recovery come to fruition, will take place here in the U.S. So I guess the question here is, should we expect a similar blueprint coming out of this very odd recession that we did from other big drawdowns and periods of malaise in the past?
That's a great point. I think the whole thing's compressed, right? So in the past, we've seen years of recovery in the economy and earnings in the markets following those major downturns that you mentioned. This time, the whole thing is compressed in such a narrow time frame, and we've seen much of that already. I think the key to next year is what kind of growth are we getting back to? You know, unlike a typical cycle, the last cycle was fairly weak. If we're just getting back to relatively weak growth, and you could argue that given how much debt we've issued, how much growth we've borrowed from the future, that we may be heading back to subpar growth once again, that may cap the momentum behind this earnings and market recovery to not be that additionally powerful. I would say that Europe and maybe Asia are on the path to a stronger recovery. China's absolutely booming right now, shifting its focus to internal consumption-based growth rather than export-led growth. I think that's a real driver of major engine for them going forward. Europe is finally getting some systemically addressing some of the issues that have plagued them for a while. I think that could mean better than the growth we saw in the last cycle for Europe. But for the US, that's hard to say. And so you bring up a good point. How much more momentum is there if we're just headed into roughly a 2% growth environment in the years ahead?
This is where the stimulus conversation becomes really important, right? Because if we knew what was coming down the pike, then we would generally expect probably bigger growth. I mean, do you believe that that's the case, Jeff? I hear a lot of people say, hey, the more spending, the more growth. Is it that simple and that linear, or do we have to see the details of where such policy will go? Is there such thing as a wasteful policy, or is there such thing as misplaced allocation of resources?
To some degree, yes. I think initially, rather than trying to don't let perfect be the enemy of good and just get the money into the system, and we do need more of that. So I think that should be the emphasis right now, and I'm sure the Biden administration is very focused on that. While we're still not seemingly able to get any kind of stimulus through Washington here year end, but maybe next year we will, and I think that's important. I think the way it's designed will ultimately be important to how long it affects the economy, how impactful it is, but certainly there's a positive impact to that spending. Look, this is different than coming out of 08-09, where the money was really designed to prop up the banks to avoid bank failures. This is different. This is checks going to individuals and businesses, which can be spent right away, much more of an economic impact.
I like that point. So the rescue here has potentially more direct influence on the economy. Jeff, before I let you go, before the opening bell, just to kind of reiterate the point here, what do you think will be a heads up to investors that this type of international interest or rotation is happening? I mean, is it already as we see emerging markets up 10% the past month? Is it happening as we see China up 6%? I mean, it's in there, but it's not quite, blowing past our own performance yet.
Yeah, it's a bit of a stealth rotation, and I think where we're starting to see it show up is an equal weighted performance. So if you look at the equal weighted performance of US and non-US markets this year, just to get a sense of what the average stock is doing, we're actually starting to see international stocks outperform, only slightly, but outperform US stocks on a year-to-date basis. As that becomes more prevalent, I think that stealth rotation will become a bit more obvious, and investors will begin to move in that direction.
Okay.